The broadcast is now starting. All attendees are in listen-only mode.
Good morning, good afternoon, and good evening, ladies and gentlemen. We're very glad to see you all attending our webinar on dry bulk market. Thanks, Antonia, first of all, for organizing it very promptly all the time. Thank you very much. My name is Jayendu Krishna, and I'm the Director and Head of Maritime Advisory Business of Drewry. I'll be your host for today's session. And we'll have four of us speaking in the session today. Rahul Sharan, who is the Deputy Director and Lead for Dry Bulk Shipping. Supporting him, we have Deepanshi Puggalok, and then we have Archit, Tewari, who is a marine engineer and an ESG analyst. At the end, we will take some questions as usual. And you'll find to your right hand side, there is a Q&A box. So please type in your questions. We'll try and best to respond to all your questions in the limited time that we have. In case we fail to respond to your questions during the webinar, we will reach out to you separately using email. In today's webinar, as you know, in Drewry we have what we call regular research reports, and which is essentially a dry bulk forecaster, as we call it. And in that, so the intention today would be to really cover what we have captured in our dry bulk forecaster, and what are the key drivers of demand and supply, and our quick take on how do we expect the earnings of the ships to be going forward. But very importantly, we will also cover some of the key issues which is rattling the world today, really rattling. The issues in the Middle East, you see the trade war happening, the USTR issues, etc. And of course, the energy transition. So these are the few things which we intend to do in the next 30-35 minutes. But before we begin, I just want to let everybody know that we do have maritime advisory services, wherein we provide very bespoke research and advisory. Then we also have an energy transition practice. Archit Tewari, he's with us, and he is part of the energy transition practice team. And we also have a separate team on financial research and advisory, which is primarily focused now on the equity research. So that's the quick one on what we have been doing. Now, moving on to what we call Drewry on Demand, which is, some of you may be familiar with it. But we launched it a few months ago. This is a very fully integrated online maritime research knowledge center for almost all the shipping segments there, and definitely we have on the dry bulk segment. And if you are a forecaster subscriber, I presume you already have access to it. If not, please reach out to Rahul and our team. I'm sure they'll be very happy to take you through that. And this, I must say that this platform is a significant enhancement to the flagship subscription service, which earlier it used to be mainly focused on the PDF report and the Excel, etc. Now, this platform is, I would say, fully integrated and very dynamic resource, which combines fleet, trade, rates, valuation, etc. And it also has the AIS analytics capability. And this is updated, a lot of it is updated weekly, some are monthly, of course, some are quarterly. And so it's you'll find that it's very, very dynamic resource that we have now for our subscribers. So that is it, I think, very quickly on what we call Drewry on Demand. Now I'll hand over the session to Rahul, and he'll take us through what our takes are in terms of the dry bulk market. Rahul and Deepanshi, over to you.
Thank you, Jayendu. Thank you. So we'll begin with the key drivers that are going to shape the global dry bulk market in 2025. Particularly, apart from the fundamentals of demand and supply, there have been quite some key issues which have been rattling and impacting the dry bulk market. As you can see, so we have tried to put some key events that have been happening in the market, or which could have a larger impact in the short term as well as in the long term for not only on the freight market but on the overall scenario on the asset values, transactions, demand, supply. These might have a very large role to play, particularly in 2025. So we will try to focus on the newly recommended USTR policy, which could, which might result in a fragmented market with China-owned, operated or built ships not going to US or restricted movement towards US. So these will have, and not only USTR, there are impacts from, for example, EU ETS. We'll see in subsequent slides where this has already been resulting into newer ships going to the European ports and older ones flying in other locations. We will try to look at how the trade war is going to, we tried to cover it in the last as well, in the last briefing that we had 3 months ago. Now there have been some recent developments which has taken place. We'll include them as well, and then the usual fundamentals on demand and supply. Talking about these tariffs, we saw this last time in Mr. Trump's first tenure as well, when we discussed some of these issues, how they have been impacting the dry bulk market, and now we are seeing it again when he took over the office in January. There were a lot of talk, and the tariffs went as high as more than 100% on Chinese goods. So it was that kind of impact it could have on the commodity prices and freight rates. But now we have seen that in the last 2 days there have been a lot of talk, and there have been it has been put on hold at least at the moment, and the tariffs have come down to 30%, 10%. But still, there has been a lot of which is looming for the market. Major commodities, even though US is not a major influencer in dry bulk market, but still it has quite a sizable volume which could get impacted. For example, grain exports from US, and a lot of them come to China. We saw in the first tenure how China moved away from US grain and started importing from other regions as well. Similarly, US tried not to import a lot from China. China in terms of steel products, it replaced China with Mexico. This time he has some emphasis on Mexico as well. So we don't know how will it actually could have moved with more than 100% tariffs. But now, since these have been put on hold, we believe that these things might not happen, and it could be life as usual in the dry bulk market, isn't it, Deepanshi? And we actually worked a lot on the last quarter, looking at the impact of not only duties but also USTR, which was recently proposed. And Deepanshi actually came out with and a very analytical piece where she intended to show the impact of USTR it could have on the dry bulk market. Deepanshi, what were you finding on that?
So, as you all might be aware, that USTR has made a proposal to impose a fee on the Chinese built and Chinese operated vessel, and the first proposal came during the February end, and we have seen a revised proposal last month. So if we compare the original proposal, for one of the main reasons why USTR proposed this was that they want to revive their US shipbuilding activities and also reduce the China's share in the maritime industry. And if we compare what was the original proposal and what is the revised proposal, then in the original proposal, mainly the fee was on the Chinese operated vessels and Chinese built vessel, and also on the vessels of any operator who have any Chinese built ship or vessel in their fleet or order book. Whereas in the revised proposal, this segment is not there. There are only two annexures which covers the Chinese operated and owned vessels and Chinese built vessels. Also, there were no exemption provided in the original proposal, and in the revised proposal, the USTR has provided some exemptions in the Annexure 2, which just caters to the Chinese-built vessels. So if any Chinese-built vessel, which is US-owned or a US flagged, that will be exempted from this proposal and will not be charged any fee. And on the similar notes, if a vessel is a ballasting vessel and entering the US port, it will not be charged any fee. Also, the other exemptions include a vessel carrying less than 80,000 DWT of the cargo and a short-haul trade of less than 2,000 nautical miles. So these exemptions were not in the original proposal. Because of that, only just 20% of the tribal fleet was out of the purview of this proposal. Whereas if we see in the revised proposal, almost more than 60% of the fleet is out of this proposal. So only 40% or 39% of the fleet will bear some fee if they enter the US port. We also did some analysis using Drewry AIS. So taking the port calls of 2024 and in the first quarter 2025, we saw that only 17% of the affected vessels, which are under the purview of this policy, made port calls at the US port. So that brings us to the conclusion that that impact will not be much in the revised proposal. And if we see the segment wise, Panamax segment will be the most impacted segment, just because that most of the trade to the US happens on the Panamaxes and Supramaxes, and Capesize, even though it is included in both the annexures, it should be included in both the annexures because of its size, cargo size greater than 80,000 DWT. Still, it will not be impacted because most of the trade from US doesn't happen on the Capesize.
So even though this is not on place, we have already seen the asset values or asset activities, it has already started impacting them, no?
So we saw that we compared the second-hand transactions from 2024 to 2025. So the first proposal was implemented in February, and from February, in March, we saw the impact of this USTR proposal. The second-hand transactions fell to almost 30% from 50% if we compare it to 2024, and the same trend is following in April also. So even though it is not still implemented, we have almost 6 months cooling period till the implementation of this proposal will happen. We are already seeing the impact on the second-hand transactions. So that
is okay. Thank you. And we also try to look at what is happening from the canal side, because initially some 2 years ago it was Panama Canal which was dealing with the drought condition, and now with the geopolitics, the Suez Canal which has been affected. But in January, when there was some truce in that region, we thought that things will improve and more ships will start passing through the Suez Canal. But clearly that is not the scenario, and since that truce was very, very short-lived, and the trouble is still, it persists there. So this is how it looks like. The transit through Suez Canal has gone for a toss.
Rahul, are you on a full presentation mode, full screen mode?
Yes.
Okay, all right, that's fine, because there's a request to make it full presentation. So, okay, fine, thanks, Rahul. Sorry to disturb.
No, it's okay. Okay. And then there's one more thing. When we began this presentation today, we talked about the regulations, particularly maybe a fragmented market going ahead. We already saw this in 2024, the year when EU ETS was introduced, and share of older ships calling at European ports had actually dropped quite significantly. And this was not the case for any one segment. You can see that this happening across all vessel sizes. So as we go into more and more into it, and with the regulations getting more tighter, we'll see these things happening, and we might see many fragmentation in the market with non-China operated or owned vessels going to US, younger vessels going to Europe. So I don't know, because the major problem is that the ownership in the travel market is very, very fragmented. So I mean, the big owners, as we can see in some other sectors, the travel market is different. So coming them together and then forming kind of pooling, and then taking the younger vessels to Europe, this might take some time before the market adjusts itself. Okay, so now when we begin our forecast, coming to our quarterly report, when we begin our forecast, we try to build scenarios against uncertain geopolitics, again economic developments, impact of various regulations. There are a lot of things already happening in the market, so we have visibility of what could happen in most of the cases. But in certain cases, for example, the global economy, now the recessionary fears are already there. Whether the global economy or a particular economy will slide into a complete recession or not, we do not have a control on that, and the visibility is a little bit ambiguous over there. So we try to build scenarios in low case, high case, and base case, taking into consideration the global economy, particularly the Chinese infrastructure and economy growth in the forecast period, and also the impact of CI regulation, because this particular regulation is important because it might have impact on the speed. We have seen this happening in the past as well. So this all put together, we have discussed them in very detail, the impact of each of these cases in the report, in the forecast report. Coming to the demand side, very quickly, Deepanshi, since you have put all them together in the report, very quickly in 1 or 2 minutes, can you please explain this?
Sure. So, taking into account, if we compare our forecast to our previous forecast, we have toned it down because of the ongoing trade disputes and trade war things. So, if I talk about a particular commodity, iron ore demand we are expecting to go up in 2025, mainly because of two reasons. The first reason would be that Australia and Brazil are trying to ramp up their production and their export before the Simandou mine starts its export later in the year. So they just want to clear up their stocks before anything like that happens. And the second would be that major Asian countries like China and India will increase its iron ore imports in 2025, mainly because that India is increasing its infrastructure development and it will need more of it to produce steel. So India is already increasing its iron ore imports, and similarly for China, we are expecting in our base case that its industrial infrastructure will improve in this year. So that will drive the growth in the iron ore market. Similarly, if we see the coal market, the coking coal trade will also be majorly impacted by the major Asian countries, mainly because China is trying to ramp up its imports because of the lower prices and in Mongolia and Mongolian and Canadian coal. Similarly, for the thermal coal, we are expecting a larger imports from India, because even though India's imports have been declining for past some months, but since India is on high alert of the heat, so India might not be able to completely use its internal production to fulfill the demand. So it will increase its imports of thermal coal, which will mainly drive the coal market. Similarly, if I look at the minor bulk market, the bauxite will be the major part, because the bauxite trade has been trending upwards since the past 10 years, and it is expected to, if we see only the first quarter, it was like the bauxite trade has kept the Capesize rates up because the bauxite is mainly traded on the Capesizes.
Perfect. Thank you. Okay. Yes. So so these were some basic assumptions that we and an outcome that we have in detail discussed in the report. Also, the fundamentals, as I spoke earlier, the fundamentals of the demand side and also the supply side, which is covered very widely and extensively in our quarterly report. You can refer to that. So I put some slides and charts from the report directly. I will not go into details of that. Just show it there. This will be part of the presentation. So later, this presentation will be shared with all of you. You can have a look on what is our take on each of these commodities individually, and also on the grain market. And when you go to the supply side, similarly, the new orders have completely dried up. So the deliveries over the next 2-3 years are expected to be very low. The demolitions, though we believe that from 25 onwards it should increase, not extensively, not very much, it will not surge, but there will be some uptake in the demolitions as well. And just one thing is that this is the impact of speed on the impact on speed of the regulations. As you can see, except for cape sizes, the speed has actually come down in 2025. For the cape size was an aberration or an outlier, mostly because the rates in first quarter in the cape size are very high. So that prompted ship owners to, or the ships to sail at a higher speed. Coming to rate forecast, so we tried to put evaluate our rate that we had to forecast in the previous quarter. So the first quarter of 2025, we tried to compare it. How do we fare? I also tried to put some Baltic spot rates, as you can see, for Cape, Pana, Supra, and Handysize as well, all 4 segments. And this is what actually happened. So the Baltic compared to the FFA and their actual rates, for example, for Panamax, it was almost close, the Baltic 2% higher. But in our case, we were bang on exactly the same rate, $13,000 per day. We said at the beginning of this quarter it would happen in 1Q25, and this is actually what happened. So this was a great analysis, and then this is what we forecast. So I will conclude with this. So this is our forecast that based on dry bulk utilization, the fundamentals of demand and supply. Based on that, we believe that the utilization will move up in 2025 and similarly in 26. Hence, we expect the 1-year time charter rate for all the vessel segments to go up in 2025. The FFA says otherwise. It says that it should actually come down. Though FFA is a spot rate and ours is the time charter rate, but still the direction is different. But as I showed that ours are based on complete fundamentals, based on demand and supply. So this is what is our forecast. So Jayendu, we began with the summary. This is all from our side, Jayendu. Over to you.
Yeah, thanks Rahul, and thanks Deepanshi for briefing us on the dry bulk market. Now, as you know, the energy transition is really gaining momentum, particularly after MEPC 83. So we have here Archit, who tracks the energy transition issues globally day in and day out. So no better person than Archit to take us through this issue. Archit, over to you.
Hello everyone. As Jay mentioned, I'll be talking about the energy transition domain of the shipping sector. So we were talking about the different regulations before this, when Rahul mentioned that the impact of CII, EU, ETS and other regulations can be seen in the industry. So in the latest 83rd session of MEPC, IMO finalized or approved the draft text for a new regulation that would come under MARPOL Annex 6, which is named as Net Zero Framework. So this decision was taken in a very unconventional way because IMO usually works with a consensus, but in this particular case, they were not able to achieve the consensus, and it came down to a vote, where with a 63:16 vote count ratio, this draft text was approved. So it was pre-planned that the regulation would have 2 aspects. One would be the technical measure and an economic measure. So let's start with the technical measure first. Yeah, can we change the slide? So yeah, starting with the technical measure first. All ships 5,000 GT and above are supposed to calculate their greenhouse gas fuel intensity, and these greenhouse gas fuel intensity would be compared to 2 targets. One would be the direct compliance target and other would be the base target. So if a vessel achieves the direct compliance target, it would be considered as compliant, and they don't have to pay any penalty. If the vessel is not able to achieve the direct compliance target, then they will have to pay a penalty, and they can reduce this penalty by achieving a base target, which is represented by the yellow zone in this infographic on your screen. And if the vessel is not able to even achieve the base target, then it would come in the red zone and would have to pay a higher penalty. Comparing these targets with fuel maritime targets, as represented by the blue dotted line in this infographic, you can see that the NZF net zero framework targets are stricter. This regulation would also have incentives provided for ZNZ vessels, that is, vessels using zero or near zero fuels or technologies. So let's move on to the economic measure now, where how will these vessels pay for their non-compliance? So here you can see three vessels, green, yellow, and red. The green vessel is the compliant vessel that has achieved the direct compliance target. Then we have the yellow vessel, which did not achieve the direct compliance target but have achieved the base target and will be supposed to fulfill their tier 1 deficit. This will be done by buying remedial units from IMO at the rate of $100 per unit. Now the red vessels will have tier 1 deficit and tier 2 deficit. Tier 2 deficit will be fulfilled by buying remedial units from the IMO at $380 per unit price. Now, the red vessel also have an option to fulfill the tier 2 deficits by buying surplus units from the green vessel, that is the compliant vessel. And these surplus units will be calculated based on the cap of the GFI of the green vessel and the direct compliance target. Now, all the revenue collected in net zero fund of IMO, part of it will be used to incentivize the ZNZ vessels that I talked about in the previous slide. Now, as I mentioned, the whole regulation revolves around the greenhouse gas fuel intensity. So what fuels to be considered for long term? If a ship owner changes over to e-methanol or e-ammonia, the vessel will not only remain compliant, but also generate a surplus, which would help in compensating for the higher price of these e-fuels to an extent. And in addition to that, they are eligible to receive incentives if their GFI is below the ZNZ limit. And this would help bringing the cost gap even further down. Now, what strategies can the ship owners adopt? So in short term, of course, they can install energy efficiency measures and propulsion improvement devices. For conventional fuel vessels, they can start biofuel blends like B30 and then progressively increase it as the targets are becoming more stringent. Similarly, for LNG fuels, they can start using blending bio-LNG with their normal LNG, and they can start ordering dual fuel vessels. Talking about mid to long term, they can use bio or blue versions of fuels, followed by e-fuels eventually, and establish long-term contracts for the supply of these low or zero greenhouse gas fuels. Now, let's have a quick look at the order book and fleet of dry bulk sector. Here we can see the methanol vessels are being ordered a lot. The whole order book is filled with 7.7% is filled with alternative fuel vessels. And we expect to see far more growth in this in the coming times because of the new regulation that has come up. Now we also undertake a lot of bespoke advisory services, for which I invite Jayendu back to the session to take over.
Yeah, thanks, Archie. So if you can go over to the next slide, please. Yeah, as I mentioned in the very beginning, that we do undertake very bespoke advisory services besides publishing a regular report on the dry bulk market and all shipping markets and the ports. So I wanted to share two experiences with you all very briefly. First is the alternative fuel bunkering. So this is for one of the major ports in China, which has been trying to establish themselves as the alternative fuel bunkering hub. So essentially, this really required looking at all the developments in the energy transition space that's taking place in the world in terms of the development of the fleet, development of the technology, development of the competition. So essentially, we looked at all different aspects of the alternative fuel development and forecasted as to what is the potential for the port concerned in the years to come. So that's briefly on alternative fuel bunkering. And the next one is directly relevant for the dry bulk sector, wherein we assisted one of the financial institutions for their investment in one of the shipping companies in Europe. So the financial institution was planning to give the debt to this company, in which we essentially undertook the commercial due diligence, the technical due diligence. It also required review of the shipbuilding contracts, also the HSE due diligence, the health, safety, and environmental due diligence. and that all of these were beside discussing what is the potential for the fleet for the company concerned, and of course looking at the global dry bulk market demand and supply, etc. So as you can see, we have been covering a whole host of issues in terms of the dry bulk market and all other markets as well. So so that is it from me on this. So Rahul, there's one question that I can see I can ask you before we close. So as you know, the China and the US is now trying to come to terms with each other. It appears that the China and the US can't live without each other, though we have heard a lot of rhetoric from the US, but that's really not the case. So how is it that you are factoring this new development of postponement of the 90-day pause or the 90-day pause in the tariff? So how do you expect the market to sort of have an impact?
I think the two things. One is the sentiment, because the short-term sentiment drives a lot. So that sentiment is going to have a positive impact on the trade as well, and that sentiment will have a good impact on the rates as well, and then increase trade as well. So the second part was increasing trade. So when US and China trade, we were expecting under the new tariff regime a month ago that the trade would actually contract on these two, especially where these two countries are involved. Now we don't see that, and we believe that this, as things are shaping up, we believe that things are past, and this should be a normal trade life for everybody, and should have pressure on the rates to increase.
Okay, thanks. Thanks, Rahul. So I think we are short of time. We are already overshot by a couple of minutes. So we should close here. So thank you all for joining the webinar today. So as always, we will be sending you the recording of the session as well as the presentation. And for those of you who are not our regular subscriber of Dry Bulk Forecaster, I of course invite you to have a look at it, and it may be of interest to you. So that is it then from us. Thank you very much, everyone, for joining us, and have a good day. Bye-bye.
Thank you. Bye-bye.
Thank you.